Hi, everyone. This is Jack Allwild with another Money episode. Today, we have very special guest, Rob Natale from North Square Capital. He is helping medical professionals buy back their time and expand their wealth through passive real estate investing. Rob, welcome to the show.
Hey, Jack. Yeah, thanks for having me. I appreciate it.
So, before we get into how you selected the medical professionals to help and talking about real estate, I do
Sure.
like to ask everyone, what was your relationship with money like growing up?
Yeah, so it's a good question. So for me, I grew up where money, it was very much kind of monitored, right? I grew up from like a middle income household. So I had two parents that were kind of knew where money was being spent. So they had budgeting wise was very strong, right? But sometimes there was friction during my childhood as far as the conversation just around money and kind of what's being spent and what's not type of scenario for me. So, but budgeting was always something that was a conversation kind of going through, like you pick up on, you notice, which I think is a good thing. It's actually something that's been instilled with me is kind of budgeting and knowing where your money is going and where it's not going. I think is very important. So that was my experience growing up in my household was again, knowing where your money's going, saving, a little bit more risk averse as far from an investment type of scenario, being more aggressive was a lot of what my upbringing around money was in my immediate household.
Mhm. So how did you phase into helping doctors deal with their money?
Yeah, so it's happened very organically. So I used to work at a company. I'm based in Boston with a pretty prominent global asset management company called Columbia Threadneedle Investments. So my experience was I was working with financial advisors out in the Pacific Northwest, and I was selling different investment products. So mutual funds, separately managed accounts, exchange traded funds, etc. And I'd be dealing with individuals and teams that had a wide range of assets they'd be managing for folks. You could be looking at as low as 20 million to an excess of, $3 billion, almost like mini family offices. And what my experience was, these teams that were managing the billions in assets were utilizing strategies that a lot of sophisticated investors, like your listeners, Jack, should be getting exposure to. And one of those is, real estate syndications in the real estate world. And it kind of felt to me like a good old boys club, like the wealthy keeping amongst themselves. And to me, I have three family members who are in the medical field. And it's such a dichotomy from where in the medical space, in the medical community, if you come up with the discovery, like you wanted that information is shared amongst the masses for the betterment of all. Versus what my experience was, it was a complete opposite. And it's just very stark. And my family members, would talk to them and, with their work, they were always putting others before themselves. So I saw the passion that they had for work, but I also saw some of the things that were coming with it where they felt, burnt out and a lot of essentially middle management kind of dictating and a lot of bureaucratic red tape dictating how they can treat their patients. So not only was I kind of seeing their pain and struggle from that perspective, I also was seeing how poorly the financial services industry was treating them. I would ask my family members, hey, what's your financial advisor doing? Like, what's your portfolio look like? And it was more or less, we're going to be in a 60-40 portfolio. They're collecting an asset under management fee of around 1%. The market goes down. It's, hey, let's just ride it out, ride the wave. And I just, again, saw how poorly they were working and treating my family. And it just got to a point where I was no longer comfortable being in that industry. I felt like more often than not, the financial advisors, not everybody out there, if anyone's listening, but there's a lot that just truly don't operate in the best interest of their clients as a true fiduciary. And I said, I'm not doing this anymore. So what I decided to do was I started a company, North Square Capital. So it's a private held real estate investment firm. And like what you spoke to, Jack, is I am empowering and helping medical professionals buy back their time, retire on their terms, expand their wealth through passive real estate investing opportunities so they can experience the benefits of owning real estate, but without the hassles of being a landlord. So that's really my story. It's my mission and why I'm doing now what I'm doing.
Awesome. So Rob, you mentioned one of the strategies you're helping them implement are syndications. For people that don't know what a syndication is,
Yep.
can you describe that for us?
Yeah, very high level. We are pooling together investors' capital to acquire a property, let's say like a 50 or 100 plus unit apartment building that they wouldn't be able to acquire on their own. And then we are relying on the general partner to execute that business plan. So when you go in as a limited partner, you are truly passive in nature. Your risk that comes along with that is, just like any investment is from a capital perspective, a loss of capital, but every other liability and risk falls on the general partner who's in charge of executing the business plan.
Interesting. And because it kind of sounds like you have like a share in the project. Is there like regulation wise, is it kind of like a security? Like, do they have to go, like, is there anything on the regulation side we should know about?
Yeah, so a couple things. They are private placements, right? So
Okay.
it's not like something you can do and go about and acquire like in the public market, like the stock market. Okay. The way it works is because you're a limited partner, right? You do get ownership in the property. So because you get ownership in the property, you do get a K-1 every year that shows your percentage of ownership and then where the tax benefits come into play. It's a huge component. So this is very different from from a REIT. And for those unfamiliar with that, a real estate investment trust. A REIT or a real estate investment trust, someone goes and invests at that. One, you don't own the underlying asset. You own a piece of the fund. Similar like if you own a mutual fund, that's number one. Number two, they do have a much higher correlation to the public markets than let's say in the real estate and the syndication world that I'm in. Number three, because you don't own the underlying asset in a REIT, you cannot experience any of the tax benefits that come with real estate investing.
Can you go through some of those like tax benefits that someone would get from investing in a syndication?
Absolutely. So let's say you invest in a syndication, okay? And let's say someone invests like $100,000. So any groups that we partner with at North Square Capital, we require that they're going to be running what we call something called a cost segregation analysis, cost segregation study. And what that does is it's essentially expediting and speeding up the depreciation on that asset. So typical straight line appreciation is 27.5 years. By conducting a cost segregation study or analysis, you are hypothetically breaking down the property into different lifespans. So personal property could be 5 to 7 years. Land improvements is 15 years. And by categorizing those, you are capturing more of the depreciation up front. And the benefit of that is if you're only going to hold on to these investments for a certain period of time, you want to capture that. The sooner the better. And because by doing that, to answer then your question, Jack, about what does that look like, on your K-1, okay, it's going to show a paper loss on your K-1. And the power of that is you can take that loss and offset it against some of your passive gains. Let's say if you're investing, as an example, in the stock market, you can offset those to reduce then your taxable income. And then if you're a real estate professional status, that's like the holy grail. You can take that and offset your active income, which is even another level. Does that answer your question?
Yeah, absolutely. And what like geographies do you operate in?
Yeah, so it is geographically agnostic. So my role at North Square Capital is to vet out the operators and the opportunities. So let's say I'm chatting with you, Jack. Jack Capital, you acquire, like you're running a short-term rental portfolio, across the country. My first job is to vet you and your team out through a number of different conversations, kind of interview type of style, as far as, is this the type of individual and group I want to work with in the first place? So inclusive of that is just running background checks amongst many other things. And then if that box is checked, then it's reviewing the individual opportunity and the business plan. If it makes sense as far as if that strategy I can see in looking through the underwriting and the geographic location, if it's something that I think is viable. If both those boxes are checked, then it's something I partner on, and that's why it's geographically agnostic.
Cool. I mean, can you give us a flavor for maybe a recent project you've worked on?
Yeah, absolutely. So right now I'm working on, I partner with a group called TechVestor. Okay,
Okay.
they're institutionalizing the short-term rental space. And I feel like a lot of
Interesting.
folks, you hear short-term rental and it's, kind of like the sky falling, there's regulations, like, oh, I think there's a lot of main headline news of that's not a good space to be in, where we see the complete opposite, where there's a massive opportunity there and how to implement and risk mitigate where we feel it's going to be a very good investment. So to give a little bit further color around that, what we're doing is the group I'm partnering with, we're across 9 different markets. So how do you risk mitigate that strategy to reduce the risk? Variety of different ways. One is going in areas where there is legislation written in place already that is pro short-term rental. So let's say the Phoenix, Arizona, market and submarkets. 2 is then looking at markets where they are heavily reliant on the tax income that is generated from short-term rentals. One of the prime examples being the Poconos. Another area is an idea and concept is you don't go into major cities, but really focusing more on secondary, tertiary cities. So as opposed to a Miami, Florida, it's a Clearwater, Florida. As opposed to a Nashville, Tennessee, we're looking at a Memphis, Tennessee. Okay. And then let's say there is a specific, crackdown in a market that we're in. Okay. The investments are spread across 140 plus properties. If that's the case, none of the properties are cross collateralized, meaning, in order to sell one, we're not forced to sell another. So essentially, if there's a specific pocket or market that we would need to move on from, we can do that. And these properties can also be converted into medium or long-term rentals as well, is another risk mitigation strategy that we have in place.
Mhm. Can you go through like what actually, like what makes something a medium term rental versus a long term rental? I guess, and then versus short term rental.
Yeah, so short-term rental is 30 days or less.
Okay.
Medium-term rental is somewhere between that. This is the way in 6 months, and then long-term rentals when you're really getting to the 9
Okay.
to 12 bucket. So it's
Okay.
really the 30 days or less is what's classified from a short-term rental.
Okay. Have you seen like many cities that do have legislation in that are like protecting short term, like turn or like
Yeah,
vice versa?
right now on the markets we're in is like in the Phoenix market and the
Okay.
submarket, one of them that has that in place.
Like if someone were to come to you
Yeah.
and say, yeah, it sounds like really interesting. Like what would be like how are the fees structured? How much would they need to invest?
Yeah. So the way it works is the minimum investment's $50,000. That's the
Okay.
first thing. And the way the structure is from a fee wise, so because I am, to give you a little more color, right? I'm partnering with TechVestor. And because I'm partnering with TechVestor, I've created a specific fund to invest into their opportunity. And because I'm doing that, I've negotiated better returns for my clients. So if someone wants to invest with TechVestor, they might get a preferred return of, let's say, 6%, and then a waterfall structure of 60-40, which I'll explain what those numbers mean in a moment for those
Okay.
folks who aren't familiar. Versus if you invest through my fund, you get a preferred return of 9% and then a waterfall structure of 80-20. And then for those who are unfamiliar with what I'm speaking about, those terms, anytime there's a preferred return, so we'll use 9%. Okay, that means before I would get paid a dime, you as the limited partner, you would have to get your principal back plus 9%. So if this is a 5-year hold period, we'll just use that for even numbers. Before I would get paid anything, you would have to get your $100,000 principal back plus $45,000. And I'm getting 45,000, 9% annual times 5 years.
Okay.
After that pref is hit, then it goes to what we call an 80-20 waterfall. And what that means is 80% then would go to the limited partners, and 20% would go, let's say, to myself. So it's
Okay.
very much where incentives are aligned, where in order for my compensation and for TechVestor from a compensation standpoint, we got to make sure that this is an asset and an opportunity that performs well.
Awesome. And I feel like I'd get in trouble if I didn't ask this, but do they have to be accredited investors?
Yeah, no, it's a good question. So for this specific opportunity, right, they do have to be accredited. So
Okay.
from opportunities, right, there's 506C is in cat and 506B is in boy. So B is in boy is for accredited and non-accredited, and 506C is for accredited. And right now, they're talking about kind of changing what the definition is. But the way some of the terminology right now is to be accredited is you're making $200,000 gross income past 2 years. You expect to make it this year. You're married, $300,000 in combined income. And then the last being $1 million net worth, not including your primary residence.
Gotcha.
That's what the current definition from an accredited investor is as of today.
Cool. So other than syndications, are there any other strategies that you typically help implement, or is it mostly concentrated on syndications?
Yeah, no. So the other is now I partner with a group called Passive Investing, and it's a real estate income fund.
Okay.
And really the power of that is the way I like to explain it is you think of like a high yield savings account right now, which might be at 4.5, 4.75%, maybe even 5, but those are starting to come down. Think of this strategy as like those type of returns on steroids. So what this strategy is, it can pay somewhere between 8 and 9% annually. And you have the ability to take either monthly distributions or, which I always recommend to clients, you let it sit in the fund because then you can let it compound and continuously build over time, which is massive. And it has 90-day liquidity. So if folks invested, they put their money in that, but then like, oh, actually kind of something came up, I need it. It's really within 90 days that you can look to get that money back. So it's a much shorter term time frame. So that's something from a non-syndication side of things that we also offer for our clients. Because at the end of the day, I'm trying to provide my clients different investments that have their own strengths that can be a fit for where they're looking to go.
Mm-hmm. So those funds you just described, where is that money getting invested?
Yeah, so if it's both the funds that you're speaking to, or just the real estate income fund that you're speaking to?
The income fund, sorry.
Yeah, so that strategy is all on single family properties.
Oh, okay.
About 70% of them are in the Carolinas specifically. So it's backed by a hard asset like real estate. So what happens is the group I'm partnering with, it's called Passive Investing. They are working with professional fix and flippers. Okay, these aren't people coming off the street like saying, hey, I want to go fix and flip a house. These are professionals who do this full time. And what they're doing is they're lending out essentially hard money lending. The rate's somewhere between 13 and 3/4 to 14 and a quarter. Okay, these loans, typical time frame is 6 to 9 months. Loaning them out, again, based off of them fixing and flipping and selling the property, where what they're pledging from a collateral standpoint is the property. They're also making personal guarantee. So in case, worst case scenario is where like they are not meeting the standards that need to be met, the group I'm partnering with, they can take the property back. So they've done in 4 years, the group I partner with, they've done about $290 million of loans.
Wow.
They've done about over 1,500 individual loans. Out of those, 3 of them have gone into delinquency. 2 of the properties they took back and sold for a profit, and the third one is like in the process of going on right now. So that's really where the protection comes in, where it's backed by a hard asset. Like we're going to just go take the property over.
Mm-hmm. Cool. Yeah, well, sounds good. Well, Rob, as we're winding down, I do like to ask everyone, what is the best and worst personal finance advice you've either heard or received?
Yeah. So we'll start with the worst and we'll end with the best. How about that?
Let's do it.
So the worst, as I'm sure you and a lot of folks listening on this call or this watching, I should say, I've heard a lot of bad advice, I'm sure. So I've heard many. One is just telling folks to take all your investment money and just 100% being allocated to one specific area, and that's it. I think it's very important to be building a well-diversified portfolio. Very important. Diversification is key. Even another quick one is just like, I'm hearing folks, oh, like you want to have balances, unpaid balances on your credit card, like you make your minimum payments, and that's a good way to build credit. Now, sure, if you have a 0% balance on there and you're making your minimum payments, that's one thing, but you don't want to have a balance that you're paying 20% interest on,
Yeah.
and you're just literally more or less flushing money down the toilet.
Yeah.
So I've heard, so you kind of just, I don't know, like, what the hell's going on here type of deal. As far as some of the best advice that I've heard and I really live by is it's kind of one and the same. Put yourself first and invest in assets over liabilities. So really taking money that you have and investing it in not only yourself to not only improve yourself as an individual, whether that be coaching, education, etc., but also on the investment side of things versus going into investing into non-essential things that you don't need, that you just want. So that's just a much more, in my opinion, prudent way to build financial stability, to where then eventually you'll get to a point where, hey, if you want to buy some of these non-essentials, you're going to be much better placed to do so.
Awesome. Well,
Yeah.
Rob, I've really enjoyed having you on the show. If there's medical professionals listening, where can they go to reach out to you?
Yeah, no, so I can be reached at northsquarecapital.com. It's my website's a contact page. I'm also extremely active on social media between Instagram and LinkedIn and YouTube, and type in Rob Natale. I'll be popping up there, and I do have a couple free educational resources that I have put together. One's called the Financial RX Playbook: How Medical Professionals Win Through Passive Real Estate Investing. Talks about the benefits, like appreciation, the tax benefits, talk about the risks, talk about questions to ask to vet out individual groups. If you're doing this independently, the whole idea is to help you better educate yourself to see if this type of investing could be right for you. And the other piece is a freedom metric calculator. The way I design this is for folks to say, okay, how much money do I need to be making in passive income to become financially independent? It's in Excel. It's very user-friendly. I record a video on it to make the best use of it. And that way you can back into your numbers. So then you can put a plan forward to do that.
Awesome. Well, Rob, it sounds like you're providing a ton of value to people, and we'll be sure to link to all of those resources. Thanks for coming on.
Thanks, Jack. I appreciate it.